Hello, we're here to talk about Silicon Valley real estate market ending the week on May 16th, presented on Saturday morning, May 17th. If you want to participate live in the presentation, just jump to chapter 12 and they'll give you the instructions on how to do that. 9 a.m. Saturday mornings is when I go live. Well, let's jump into in each one of these chapters. You can jump to the section that you find most interesting for yourself, and the timestamps are in the description below. Moving on to the first summary data slide. Here's looking at the sales volume, and I started doing this concern about the impact of the tariffs on the real estate market. And basically, we've been at the low end of the number of sales volume for all of 2024 and basically all of 2025. So the volume of sales doesn't appear to be adversely affected. And that's just on a global level, and that's looking at 1 week. When you look at some of the data otherwise, it does look like there was an initial dip in the number of sales, and then the sales volume is increasing again. But it's still probably below, well, it's below where it's supposed to be because it's supposed to be up here at the gray line. So for whatever reason, there is a significant decrease in the number of sales volume compared to where you'd expect it to be. And we're at the very low end of where your expectations are, because the blue line represents the 10 percentile volume of sales based on the past 10 years, being 2015 through 2024. And the reason the blue line is so wiggly through here is Easter moves around, and I actually have the year count for each of the years that's involved, including the current year, which is why that adds up to 11 and not just to 10. And here's the summary slide, and this really summarizes everything. You got Santa Clara County on the top of the micromarket area, San Mateo in the middle, and Alameda in the bottom. On the left-hand side of the graph here, that's all blue, which favors the Spire, except for Saratoga Las Gatas, indicates that Silicon Valley and almost all the micromarket areas is cooler than you would expect it to be for this time of the year. In other words, I'm comparing the same week to the same week for the past 10 years, and the market's not doing as well this year as you would expect based on those past 10 years. But even though it's not doing as well as Silicon Valley normally does, if you come over here and look at the individual metrics of how the market's doing, it's still doing phenomenal. For example, 75% of the sellers are selling their property in roughly 3 weeks. Yes, there's some that are longer than 3 weeks at 24 and 30 days. 36 is the highest I'm seeing right off the bat, but there's also some that are significantly lower and closer to 2 weeks, around 15 days and 13 days. So overall, the market's still hot. It's just not as hot as it normally is in Silicon Valley. Buyers and sellers aren't going to see the frenzy of activity, but they're still going to see a fair amount of activity, if that makes sense. And in fact, if you come over to overbidding, the magnitude here, you can see, got down 11% up here. You come down to Berkeley and Alameda, the island, and you have almost 20% overbidding over the seller's ask price. And the lowest number I'm seeing right off the bat is 0.3%, but most of them are in the low single digit range. And then as far as frequency of overbidding, you're basically hovering around 2/3 to 3/4 of the sellers are getting more than their asking price. So that's sort of a quick summary of what we're doing. Now we'll get into the specific summary. And this is my first normal data slide. Inventory. A quarter ago, 13 weeks back, you were at 7% more inventory you didn't expect, and that was 1,600. You're now at 3,300, so your inventory level has doubled. But more significantly, because it normally increases at this time of the year, inventory now is 34% more than it should be. And this is for all of Silicon Valley. So we're looking at 3 counties combined: Santa Clara, San Mateo, and Alameda counties. So you got not a huge surplus of inventory, but you have a surplus of inventory. And then we've talked a little bit about the offers already. Offers accepted 13 weeks ago was only 85% of where you'd expect it to be at 1,400. It's now 50% higher at 2,270 transactions, offers accepted, but the percentage of normal has dropped down to 78%. So you've had a drop in the percent of normal by 7%. So you're basically 10% of your transactions, offers accepted, have disappeared over the last 13 weeks. And you can sort of see that because that's measured by the distance away from the gray line. But if you're looking for more consistency, look at the relationship to the blue line. It's been basically close to the blue line and, sort of hugging the blue line. So you have a cool marketplace as far as the volume, but also better than 1 year in the past 10 years. You can make anything you want by out of statistics, but that's why I compare the same week to the same week, because real estate is a weekly event, not a monthly cycle, which most other people that look at the marketplace talk about. Transactions, really not a leading indicator, but it's on here for closings. Is that what powers the industry? And you can see we started off 13 weeks ago at 75% of the market you'd expect, so you were missing a quarter. You're still at the same level, so 74%. So you lost 1%, but that's nothing. But look at what happened in the market. We went from 950 transactions up to 2,000. So you've more than doubled the number of transactions where the percentage of growth is the same. And that's sort of what I was trying to say earlier, is we've been floating around the 75% with some fluctuations of the number of transactions you'd expect. So we've been missing about 25% of the buyers out there with their offers. Now we talk about the days of unsold inventory, and that's basically the seller-buyer supply-demand balance that's so important in a free capitalist society. And we went from 40 days, which is right on the cusp. I normally consider something like 40 to 80 days to be a balanced marketplace, 6 to 7 weeks, something of that order. You know, the exact cutoff points vary depending on what chart I'm looking at. But basically 40% is at the slow end of a seller's marketplace or the beginning of a balanced marketplace. And that's 15% slower than it normally is. So that's what I'm saying is even though it's Silicon Valley is slower than it typically is across almost all three metrics, it's still doing reasonably well because to sell your entire inventory of property in 40 days is pretty quick compared to anywhere else in the country. In fact, many places in the country consider 3 to 7 months to be normal inventory. That's between 90 and 210 days. Here I'm talking about 40 days. That just gives you an idea of how quickly Silicon Valley turns over, in large part because of the shortage of housing stock, not inventory, but housing stock. Now you're at 70% slower than normal, and you're at 51 days. So not only has the market slowed down by 11 days, but it's also grown in market time. So in other words, it's slower now, more slower now than you'd expect. It's 70% longer days of unsold inventory now. You know, basically 30 is the target number, the typicals with the target number you'd expect. The slowest you'd really expect is 43, and you're at 51, which is why you're above the blue line. You're cooler, longer day turnover time than you'd expect. Now, marketing time is very related, and that's the time it takes the 75th percentile seller to sell. So you look at 3/4 of the seller, what's the longest time for that 75% of the sellers to sell? Or another way to short, what is the shortest time for the 25% that haven't sold? So you're looking at the 75th percentile. A quarter ago it was 13 days, just shy of 2 weeks. It's now 22 days, so now you're a day longer than 3 weeks. But notice you went from 29%, so that was on fire. I mean, that's saying that normal was almost 4 times 3 would have been about 40 days. So that when you multiply it by 29%, you get 13. And now you're at 22, but that's 33% slower. So the speed of the marketplace, the marketing time has gone from 30% to 130%. So from much shorter than normal to longer than normal. And, you know, typical 17, the longest you'd expect is 18. You can see how close together the numbers are. It sounds pretty dramatic here, going from 30% to 133%, but most of that's just the timing. The timing of the market is such, there was a shift in the timing for whatever reason, and it's a very unusual occurrence, and that's why it happened. And you can see how the purple line, well, we're missing the dip down, but basically the purple line was up here and it dipped down and crossed over just off the screen, so just a little further back than 13 weeks ago. It happened right at the first of the year, so I would have to go back. 13 weeks would have been April 1st, so now you have 4 more, 7 more. So about 20 weeks ago is when the shift in timing happened. Moving on to price reductions. This is the seller's price reductions before the offer comes in. This is what they have to do to attract the offer. So this is basically sellers' expectations when they put on the market, the house on the market versus the market realities. And they were somewhat aligned, 0.4%, and that was 87% of what you normally do. Normally the price reductions are just a little bit higher, 13% higher of 0.4%. And the reason the 0.4 is such a small number and it seems trivial is the vast majority of the sellers do no price reductions at all. So when you look at the average price reduction, it's a very tight metric. Now you're at 101%, so you're taking a 1% price reduction, but that's 250% of where it normally is, because typically at this time of the year, you're only doing 0.4% price reduction. So you're doing 2.5 times that, which is how you get the 250%. And you can see that the real change started back here right around 10 weeks back. You were right on the typical line, then you were a little bit below the line. And then here at about 7 weeks, you raced down very quickly. And then after about 4 weeks ago, you dipped below. And we're right now here where I talked about it being 250% of bigger price reductions than typical. So sellers are now taking price reductions 2.5 times larger than they typically do at 1%. So it's still a fairly small number, but the reason it stays a small number is sellers that are coming on the market now are the most likely sellers to sell, and they're doing the homework based on the best information they have available. So they're adjusting to the new markets. Overbidding. This is not a leading indicator because we have to wait for the escrows to close to find out what the sale price was. You can see that the overbidding 13 weeks ago was 5.3%. Typically it's 3.5. So the overbidding was actually more aggressive than it typically is, which is why the purple line's above the gray line. But fast forward to just about 3 weeks ago, and it rolled over the gray line, and now we're below. So now we're taking 6.8% overbids on average versus the 7.6. The median overbid is lower. I think it's about 4%. The average is going to be higher because you have people coming in and overbidding by 20%. That brings up a lot. And this is basically a measure of how much competitiveness the buyers feel when they're trying to get an offer accepted. And again, remember, this is lagging behind by the length of escrows, which typically are running a 4 to 6 weeks. Now, there are obviously some that are closing 1 and 2 weeks, and there's some that have trouble and take on 10 weeks to close, or never close, in fact. Here now is looking at the 3 key components over time. The purple line is your inventory. So you can see at the first of the year, we had the shortage of inventory down here around 73% of the inventory you'd expect. You can see you basically went up straight until about 4 weeks ago, and you were at 138%, something like that. And then you did some bouncing around, and right now we're about 134% of normal. So you have 34%, a third more inventory than expect. The rapid increase that we saw for the first quarter appears to have leveled off, and second quarter is basically flat at somewhere around 130, 135% of the inventory you'd expect. And also, that's sort of the highest level of inventory on a percentage basis that we had any time except right at the end of 2018 and the beginning part of 2019. So we've had more inventory now than any time since the pandemic, which is back here in 2020, which has been basically governed by a shortage of inventory. And that's sort of the biggest shock that I think is going on in the marketplace right now. You've gone from a shortage of inventory to a surplus of inventory, and actually inventory that's been higher than even before the pandemic. As I said, only that short time right at the end of 2018 and 2019 had a larger percentage of inventory than expected. And this is where you start seeing it. Real estate has a huge annual cycle. And so comparing the same time frame is really important. And if you compare like 10 years of those same time frames and set that your base, you can really start seeing, is this increase in inventory that people are experiencing normal or more than normal? And this spring, not only is it increasing because it normally increases, it was increasing at a faster rate, which is why you went from 73% up to 135%. Moving on to offers accepted, that's the orange line down here. And again, if you look at this, the only time in the last 10 years that the offers were this low was 2023 and forward. Why? We had the price correction of 2022, and that sort of spooked people, and the volume just hasn't come back. So 2023, 2024, and now the early part of 2025 has been characterized by this lack of offers. And when I say a lack of offers, it's running about 75% of where you'd expect it to be. In 2023, it was down around 70%. 2024 was probably closer to 80%, and right now we're at 78%. So, rough numbers, 70 to 80% of the level of offers you'd expect. If you look at the more important indicator on this graph, the days of unsold inventory, the gray line, that's showing up here at 170%. And I actually had to expand my scale on my y-axis just a couple weeks back, I think it was 2 weeks back, to go above 170%. Now it's rolling over right at 170%, but when it had been shooting straight up, I didn't know that it was going to roll over, and I assumed it was going to continue. But again, the takeaway is it's higher than it has been at any time. Higher DUI is a slower turnover rate of the marketplace, which is actually a negative feature, or a feature that favors buyers and hinders sellers. It's taking longer to sell all the existing inventory. And you can see the peak back here in 2019, end of 18, was a little bit lower. So even though you have a little less inventory, you actually have a slower marketplace because the level of offers is slower. It's the ratio and more indicative and a more important feature. So each one of these is important. Inventory level is important, offers are important, but the ratio is even more important. And that's where we're setting record high numbers, which is actually a slightly negative thing for the marketplace. Now we're looking at each component individually. Again, this is still Silicon Valley. Here you can see inventory. You can see how at the beginning of 2025, beginning of this year, you were down here with a hot inventory, and you can see it was there for some period of time. Basically halfway through fourth quarter of 2024, all the way to New Year's, it was characterized, and granted that's only, 7 weeks, 2 months. So basically November, December is characterized by a lack of inventory. And then all of a sudden we turn around the New Year's, and you've rapidly caught up to the gray line, followed that for a couple of weeks, and then boom, rapidly caught up to the blue line, followed that for a couple of weeks, and now we're above the blue line. So we have more inventory than expect, because again, the blue line favors the buyer all the time. So in the case of inventory, a lot of inventory favors the buyer, so that's the 90th percentile. Here it is on a percentage basis. You can see that we have higher inventory than any time other than 2018, the end of it in the beginning of 2019, and this is on a percentage basis. So that's where you look at where it's supposed to be. Now you look at the offers. Here you can see the offers were, bouncing around the blue line on both sides. Here you had a little bit in 2024 where you're above the blue, then you were a little bit below. Then at the end of the year, you were above. At the very end of the year, you were right on the blue line. You came around all the way through, halfway through first quarter, right on the blue line. And then all of a sudden we took off, and we were getting close to the gray line, and it's hard to tell because it's the vertical separation. So there is still some separation. But here, right at the second quarter break, we had a drop in the number of offers. So here's where the market turned off, and that's when I started developing my 1 week measure. But now you can see that the market's turning around and coming back up. So we basically are now following the normal pattern again, but you've lost several weeks of growth. And so the volume of offers is quite a bit less than you'd expect. You can always look from where we are now. Are we going up more rapidly or less rapidly than you normally were? Right now, I'd say it is. In fact, what I would really say is it looks like it's mirroring a slow marketplace, the blue marketplace, but just a little bit more volume than the blue line itself. Even the dip follows, but this dip is caused by a couple factors. Remember, we had COVID and we have Easter, and when you're looking at the bottom 10 percentile, those negative impacts are falling there. So this dip part of what this dip is Easter, but a holiday dip is normally deeper than that. If you come up here on the monthly, you can see, this is probably Labor Day right here. This is probably July the 4th right through here. And maybe this little dip here is Memorial Day that we're coming up to next week. So here's the offers on a percentage basis. You can see we were way up here in 2021. We had way more offers than you normally do. It dropped, and then we had the 2022 price correction. And look at that drop. That was a free for all. We went from 115% of the offers you'd expect down to something like 75% of the offers. And then we basically were plateaued. But if you look at a little finer, you continue to drop through 2023. And then 2024 recovered a little bit. And so far in 2025, there might be a slight uptrend in general to this. But right now we're at the low point. So it's basically, you could argue it's straight across flat. Everybody's interpretation of the data when you start getting into that level is up to them. This is the facts of what the data is doing. How you interpret them is up to each individual person. Here's the days unsold inventory compared to normal. So you can see it's higher than normal. You're above the blue line. It's higher than you'd expect. And if you look back over the graph here, there's only little periods of time where you were above the blue line. In fact, this is COVID right here where we had shelter in place and couldn't even show houses. And so, of course, the number of offers is down, which increases your DUI. And then we had something again right at the beginning of 2019 where you were above the blue line. This blue line ends right about here because the 10 years is the same back here. It's only a moving average in the last couple of years. And so, you went one and COVID too. So you've only been above the blue line 2 times that I'm picking up easily. Up right here in the 2022 price slowdown, we were above the blue line. And it looks like maybe at the beginning of 2023, we were in the blue line. So a couple times. But now you're significantly above the blue line, and you're not at the end of the year holiday where it's easier to shift a little bit. So the days unsold inventory is clearly higher than you'd expect. Here's a record, and this is what I was trying to do on the previous chart. Basically, here you're doing it on a percentage basis. So the only time it's been this high is during the shelter in place in COVID of 2020. So basically, we're having the slowest marketplace, but I forgot what the turnover rate was it 41 days? So even though it's the slowest that it's been in the last 10 years, it's still relatively fast. For the bulk of the country to say they expect 3 to 7 months, and we're talking about being slow at 40 days, that just gives you some magnitude on how insanely fast the Silicon Valley marketplace normally is. Here's marketing time, and here we can see the shift that I was talking about. See how the marketing time normally hits the peak of about the middle of January, the end of January? Here it hit right at the end of the year. And if you look back, the gray line is going to be the same, but even look at the purple line. This is the beginning of the year. The purple line is after the beginning of the year because the green line is where I shift scales. I'll mention that real quick. To the left of the green line is a condensed scale. To the right of the green line is an expanded scale, 2x, on the date line so that you can see the trends a little easier and yet see 10 years of data. trying to get 10 years of data on a small screen isn't all that easy to do. So that's why I've done this hybrid of, to the left of the past 2 years is on a condensed scale. The past year and the current year are on the expanded scale. But if we come back and look at this, you can see the purple line peaked right here halfway through first quarter. Purple line peaked maybe a week or two into the first quarter, but you were so on fire, there wasn't much of a peak. Here it's mid first quarter. Here it's second quarter, so later than normal. Here it's a little bit early, but it's clearly close to maybe a quarter into the quarter. So 4-5 weeks into the quarter. Here's mid quarter. So you get the drift that basically this purple line, this is the earliest shift in the purple line out of the last 10 years. And that's why we improved and had such a low percentage. And the only reason we were below the blue line, it's following the gray line pattern, but it's shifted to the left by almost 7 weeks, which is a pretty significant shift. And also the upturn here has shifted because normally it's halfway through second quarter. Here it's shifted halfway through first quarter. So you can see that, is it a time shift that's happening for some reason, which is very unusual. As you can see, it hasn't happened anywhere this magnitude of a time shift before in the past 10 years of data that I'm showing on the screen. And I don't remember it happening, but that's why right now the marketing time, the 75th percentile of days on market is so high compared to normal, is more this time shift than a really shift. But, you know, because if you go out just a couple of weeks, you're now underneath or at the blue line. How significant is it? It's open to interpretation. Here's the time shift because the marketing time decreased earlier than it normally does. You remember by that half a quarter, by that 6 weeks. Now it turned around. This is where the slowdown was a whole 13 weeks ahead of time. And boom, it went up. And you can see just this last week, it turned around and it improved slightly. So now we're back down to that 32%. Just last week, we were up here about 147% of normal. Now, if you go back and look, you can see there was times here in 2019 where we were higher or at the same level. And again, even here in 2022 and 2023, we're roughly the same levels. So marketing time, the 75%, 3/4 of the seller selling in is actually at record high numbers, but it's really not setting record high numbers like the DUI. And one of the differences between DUI and days on market is days on market only counts the successful sellers, because if they don't get an offer accepted, you don't have an endpoint on those days on marketplace, where DUI is impacted by a seller coming on because while he's on the market, he counts his inventory, whether he sells or doesn't sell. Here's the largest 10% sellers. This is the 90th percentile seller price reduction. And you can see that seller that's taking the big price reductions is taking a fairly large price reduction. It's basically 13%. So for a seller to take a 13% price reduction, that was a pretty rude awakening, because most sellers are reasonable when they're pricing their homes and price, you know, where they think they have a reasonable chance for selling, and then to have to take 13% off of that is pretty significant. But that's only the sellers that are taking the largest price adjustments. Here's on a percentage basis, so you can see that we're close to record high numbers. And again, the only time that we were higher than that was after the price correction, and that's right here in 2022, starting right around Valentine's Day of February of 2022. You started taking larger price reductions and quickly got up there. And by July 1st, you were taking record high price adjustments. And you did that for the balance of 2022 and early 2023. We're basically at the same levels right now. So we're taking fairly high price adjustments, and that's happened all since halfway through first quarter. So basically in the last 13 weeks, we've gone from taking less price adjustments than normal to more. Here's the seller's average price reductions. I don't like that as much, but you can see that the average seller is doing a 1% price adjustment. Even in a hot marketplace, the typical seller does some price reduction because some sellers are always going to overshoot. And the gray line is where you'd expect the market to be. So we're just taking larger price reductions now, but the magnitudes are not that large because a large number are zero price. Here's on a percentage basis. So you can see in 2022 and 2023, it was larger, as well as in 2019. But you can see the huge increase in price reductions. And you can see there's been some improvement recently, not in the fact that the numbers gone down that dramatically this year, but the numbers normally increasing as well. So it's a combination of a normally increasing line as well as this year's line decreasing that create that big increase. Here's the frequency. So you can see the frequency is increasing and now the frequency is leveling off. But what is it? It's 15%. That means right now, even as pessimistic as I may be sounding, 85% of the sellers don't have to do a price adjustment at all to get the offer in and accept an offer. Now, the offer they accept might be lower, but it can't be that much lower because the average overbid was, I think it was 6.8%, and the median overbid was like 3.4% or something of the order. So the big takeaway here is the vast majority of the sellers price their home correctly and don't have to do any price adjustments. Here's the frequency. You can see we peaked off, and we've actually, last week was probably the most frequent, and this is a percentage of normal. So we were at 165% of normal, and now we're about 157% of normal. So clearly still taking more frequent price adjustments again, but again, that total number is only 15%. So that's somewhere between 1 out of 6 and 1 out of 7 sellers doing a price adjustment. Or another way to say it, 5 out of 6 to 6 out of 7 sellers aren't doing a price adjustment. Here's the magnitude of overbidding, and you can see how it fell off on basically right at April 1st. But you can't reasonably put any of this on tariffs or the stock market crash because these escrows need time to close. So these April 1st transactions that are already rolling over and coming down on overbidding were negotiated 4 to 6 weeks for the vast majority of them before April 1st because of the lag time caused by the duration of escrow. And that's why the bottoming out happens, midway through first quarter instead of very close to the first of the year when buyers come out of the woodwork and start buying properties. But anyway, overbidding right now, and this is the median overbidding, and you can see it is just over 4%. Typically it's up here at 5.5%. Now you're at 4.5%. Here's the overbid compared to normal. So you can see that just recently, about 3 weeks ago, we crossed over, and we're now getting less overbidding than normal. The times where we've had the same thing happen was again after the 2022 price reduction, immediately after the shelter in place, and that was largely triggered by the shelter in place, and again back in 2019. Here's the frequency of overbidding. You can see it's turned around and coming down. So 69% of the sellers are getting more than their asking price. So that's almost 7 out of 10 sellers, 3.5 out of 5. Well, 7 out of 10 sellers are getting more than their asking price. So that's pretty good. Now, granted, that's 5 weeks ago, and the numbers probably come down a little bit, but it's probably in 5 weeks from now will probably still be over 60%. There's no way to know what the number actually will be, but it's not coming down that steeply yet. Here's on a tip versus typical. So we had 10% more overbidding than normal, and now you're 10% less overbidding than normal. So you went from 10% greater to 10% less than normal overbidding. Here's pricing, and this is where interpretation comes in. Do you have a 12.5% increase for 8 years, and then a 3 1/3% increase for the last 3 years, or do you have 11.4% overall? And if this line stays up here, this is the current sale price, I may have to make an adjustment to both of these, but I'm expecting this to roll over and come down. I was actually expecting it to be, I wasn't expecting the trend up to continue much past April 1st, but yet, here we are halfway through second quarter, and the trend still appears to be upwards. It's not very steeply up, but that's still a decent rate of appreciation. If the slope of this straight line, because this is on log paper, is 3 1/3%, and this slope is 11%, it's somewhere in between those two numbers, and it's closer to the 11%. So right now, homes are appreciating at 11%, but that's the median price home. And a very real possibility that I don't measure for is it could be the more expensive areas are more active, and the less expensive areas that are more dependent on loans are less active. So if you have fewer low-end transactions and more high-end transactions, that's going to raise your median price, but have no impact on property values. It's a market mix. And in fact, if you pay attention to some of the micro market data that's coming up, you'll see that that's most likely what it happens. When I say I don't track it, I just don't have a quantitative number on it. Here now we're moving on to the distributions. The distributions show you every transaction. Well, the vast majority of transactions. I drop off the 10% that are on the market for the longest period of time, and I drop off 50% that are on the market for the least amount of time. And the reason I don't drop off this 50%, you can see here, even from the typical years, your range is very small, and you want to get some sort of change in your number. So you'd rather be out here measuring your market changes. And what I settled on was the 75th percentile. I settled on it, and it was a random guess initially. In hindsight, I probably would have rather been up here somewhere around 82.5% midway between these two data points. But the reason I'm sticking with 75th percentile is quadrants are fairly common in statistical analysis, and I don't want to do anything that's too weird. So what we do here is we look at the current line, which is the purple line, and that's what we're going to then get to at the end. But a year ago line is the dotted line. So you can see the market is quite a bit cooler because it's taking longer across the board, even the 50% down here, even the median's longer. It's just when you look at the median, it's only like 1 day longer. You come up here to the 75th percentile, and now it's 2-3 days longer, and you can start seeing it. But what this graph allows you to do is you make a little bit of an assumption or a big assumption that the market is annually driven. And so whatever happened last year is most likely going to happen this year. So in other words, if this dotted line starts cooling, this purple line will start cooling probably next week. If this dotted line improves and then starts cooling, this will improve and start cooling. What will really happen? We'll see the dotted line. You've got one dotted line right here. So I expect that to be the next one, and then it cools. So one more week. So let's go through and see. There's the same. Oh, it was actually cooler. So it was a little bit cooler. So I'd expect this purple line to start cooling off and going more and more cooler, longer marketing times. Now you're sort of in the end of the year time frame coming up here. Halloween, you start slowing down. So longer marketing times. There's Christmas, longest marketing times, rapid improvement. Now you're already starting to slow by before March 1st. And so you're slowing down coming into this data point. So March 1st was sort of the slowest for the fastest for this year, and we're already slowing down. I'd expect longer and longer marketing times for the balance of the year based on what happened last year. You can't predict the future from the past, but it's your best indication on broad concepts like this. If you have a thing like the real estate market that follows a significant annual cycle, and last year's annual cycle was a slowing at this time, you'd expect this year to be a slowing of the marketplace as well. Now we move on to price reductions. Same exact concept. Here I'm only dropping off 2.5% of the top sellers. I'm dropping off 82.5% of the sellers that are taking the least price reduction. Why? Because even here in the coolest year we ever had, they were only taking an 8% price reduction. But if you look at the reasonable thing, you got two lines here that are taking price reductions, but the vast majority are 12.5% or 10 and 15% or less. So adding a bunch of zeros in the data just complicates the reading, in my opinion. So concepts the same. Here's where we were last year. So significantly lower price reductions across the board. The purple's where we are this year. See, right off the bat, you started to decrease. So I would expect the same thing to happen this year. So for the purple line, I'd expect greater and greater price reductions. Now we're approaching Halloween. Right, there's Halloween. Now we're approaching Thanksgiving. There's December. Biggest price adjustments were right at December. Now you're in February. Valentine's Day had the least amount of price reductions this year. And then ever since Valentine's Day, sellers have been taking larger and larger price reductions. And again, now the purple is where we are now. So again, just like in 2022, in my opinion, the market peaked right at Valentine's Day. So we have 2 years now out of the last 10 or 11, since I have 10 in my base. The peak of the marketplace was Valentine's Day. Now, a lot of people think it's early. That's because things like prices are delayed by 4, 5, 6 weeks from then. And that's sort of an unusually early shift in the marketplace, but it does happen that early. It also happens as late as, Memorial Day. Typically, the volume month that's the highest is the month of May. So right now we're in the month that we typically have the most volume. Here's overbidding. Again, the same concept. Here I knock off the top 5% and it'll go all the way down to 5%. So here it's evenly distributed. I'm just knocking off the extremes. We're on the purple lines where we are, but we're starting off a year ago. You can tell right off the bat, this looks like one of the hottest years on May 17th. So sort of the peak overbidding in May. And, it also depends on what metric you're doing, because price reductions is back in February, but overbidding is May 17th of last year, because you can see there's no lines above it. So let's step through. Basically one level, and then it started dropping. So I'd expect since we're already downturning, and we'll see that when we get there, that I'd expect it to drop some more. Coming up on Halloween, right there's Halloween, and now it's starting to drop off, and there's a little bit of a delay because of close of escrow. So there's the bottom, and that was January 31st. But if you subtract off 4 to 6 weeks back in time, that's when the peak is. You're getting real close, and you can see you're coming down for this current year. There's the current year now. So you can see that we've turned around several weeks ago because all the solid lines are above the current purple line. Here now is looking at the 3 counties individually. So you have Santa Clara County in the blue, San Mateo County in the orange, and Alameda County in the gray. So Alameda County has the most inventory, and very quickly you can see that it's got sort of its typical level of inventory. Santa Clara County is above where it's been since the pandemic, but probably below its typical pre-pandemic level. And here's 2017, where we had 2 years of rapid appreciation that ate up our inventory, which has led to the slowdown in end of 2018 and the beginning part of 2019. And it was mostly still Santa Clara County got impacted. You can see San Mateo got impacted a little bit back here, but Alameda County had a completely normal year. The biggest impact was just Santa Clara County, and that's why I follow not only Silicon Valley, but the 3 counties and then the 20 micro-market areas within the 3 counties, because each micro-market area can be doing something that's completely different. In fact, earlier I started off this presentation with a summary chart of the micro-markets showing that Saratoga Las Gatas was the only micro-market that was doing better than it typically did. And I think the days unsold inventory was 75% of where it normally is, where everybody else was over 100%. Everybody else was blue in color or white in color, and Saratoga Las Gatas was the only red color in that initial table. So here you can see inventory is growing in all 3 areas. There's no indication, except for potentially Alameda County. There's a little bit of a softening here where it might be rolling over. Santa Clara and San Mateo County, the inventory is growing. San Mateo did an unusually large increase this last week. We're also approaching holiday weekend next week, Memorial Day. So a lot of sellers may have been rushing to get on this week before the holiday week. Sellers don't like coming on the holiday weekend. There's less activity. Here's the offers accepted, and here you can see the downturn in both Santa Clara County and Alameda County. But now here, San Mateo County didn't have that U shape. And in fact, when you go back and I only showed the Silicon Valley overall, but if you go back to last week and you look at San Mateo County, initially San Mateo County just kept on going like it was normal. So each county, again, has its own behavior. But you can see the market is turning around, but we've lost ground because you normally are going up from here to the middle of the quarter. Now, what's interesting, and there's no way to know, is it going to go up to mid-quarter and turn around, or will go up past mid-quarter because of this slowdown, this U. So, and then Alameda County actually had a little bit of a leveling off before the April 1st quarter change. So it's, because Santa Clara was coming straight up to the quarter, did this huge turnaround. So Santa Clara County more driven by stock than San Mateo and Alameda County. I don't know that data. I don't know anybody that knows that data. Here's your days unsold inventory. So Alameda County is the slowest because it had the most inventory and fewer sales. Santa Clara and San Mateo County are pretty close together, but with the increase in San Mateo's inventory, their days unsold inventory increased because buyers haven't had an opportunity. They're having that opportunity as I speak on Saturday and Sunday to look at the new listings, and then they'll have an opportunity to present their offer later in the week, probably Tuesday through Thursday. So there's a 1 week lag time between new inventory and offers based on that new inventory. Here's marketing time. You can see that Alameda County is flat for a couple weeks now. Santa Clara County is flat from last week to this week. San Mateo County is still growing, but 21 days to sell 3 out of 4 sellers. Alameda County being the slowest at 25 days to sell 3 out of 4 sellers. That's not even a month. And as I've said many times already in this presentation, most parts of the country consider 3 to 7 months to be typical. We're nowhere in that league. We're down in the days range, not even the months range. Here's the price reductions. This is average. So you can see all 3 counties are right around 1% price reduction. Alameda County is doing the most price reductions at 1.1% price reduction. Santa Clara County is right at 1%. And San Mateo County has the least at 0.9% price reduction. Here's the frequency. Most common in Alameda County at about 17.5%, Santa Clara County about 14.5%, and San Mateo County at about 12% of the sellers are doing a price reduction. So in the most common area, it's 1 in 6. In the least common, it's about 1 in 8. So not very common as far as your price, and not much difference. Here's the average overbid. The San Mateo County has the least overbidding in magnitude at 5.5%. Santa Clara County comes in about 6.5%, and Alameda County has the most overbidding at 8%. That's sort of interesting. Alameda County had the slowest marketing time, the slowest days unsold inventory, so you'd expect the least overbidding. I think what's happening is sellers are coming on the marketplace doing a price reduction, because remember, it had the largest and the most frequent price reductions, and then they overstepped down in the downward direction, the marketplace. So buyers, even though the seller had a large number of days on the marketplace, if he overshoots the market, the buyers have the fear of loss and they jump in and overbid. And that's why I believe Alameda County is having the most overbidding. Why they have the most overbidding is irrelevant. The important part is they are having the most overbidding. That's the important part. It's nice to try to put a theory on behind why, but it's more important to understand what the buyers are doing and what the sellers are doing instead of why they're doing what they're doing. Here's the frequency of overbidding. You can see that all three are pretty close together. San Mateo County has the least amount of overbidding, about 65%. Alameda County, about 69%, and Santa Clara County at just over 70%. Here you can see the appreciation since the last 9 months of 2015. Santa Clara County is the most at 120% appreciation. San Mateo County is at about 90% appreciation, and Alameda County is about 79% appreciation, which is really becomes a very good appreciation rate if you're the typical buyer buying with like 20% down and 80% loan, because you get all the appreciation. You get the appreciation not only on 20% down payment, but on that 80% loan. Here's the sale price, and this is on log paper. You can see that San Mateo County jumped up last week quite a bit. Santa Clara County is right here, the horizontal lines. So Santa Clara County is at right above their previous record high prices. San Mateo County is basically very close, but still below their previous record high prices. Alameda County is like San Mateo County in the fact that they're still below their previous peak prices. So again, clear evidence that each of the three counties behave slightly differently. Here's the same information on regular paper. Here you can see that the blue line is on top of the orange, so you can see both numbers more clearly. And again, you can see that Santa Clara County is above their previous peak. Is that because property values are higher, or is that because there's a market mix? I would actually say it's a little bit of both, but market mix is definitely impacting it. San Mateo County is below their previous peaks in 2022 and 2024, as is Alameda County. Here's an estimated payments assuming an 80% loan using the Freddie Mac interest rate, and you can get better interest rates than that by doing jumbo loans, because jumbo loans are less expensive than conforming loans, a reversal that happened, 15 years back or something like that now. Here we move on to my micro market data. Here you can see Saratoga Los Gatos being less inventory than normal. Everybody else has normal or greater than normal inventory. And even the white ones, everybody's greater than normal. So everyone has higher inventory than they normally do, except for Saratoga Los Gatos, it only has 75% of its normal inventory. You can see up here, the Silicon Valley has 34% more than normal. Santa Clara County has 22%. And I try to make it easier by putting the dashed lines at the end. So the dashed lines are county data or Silicon Valley overall. San Mateo County is 60% more inventory than normal, and Alameda County has 35% more inventory. And I don't have micro market data for Alameda County for the first three slides, just county-wide data. Here now is the offers, and again, everybody is blue in color. Saratoga Los Gatos is white in the number of offers, which means close to normal, in that case 88%, but you can see most of the areas are blue in color. And then because of their DUI, it's barely pink because it's at 86%. So it's really the lack of inventory in Saratoga Los Gatos that made it pink. Here you can see I'm seeing 235% up here. Is that the highest? 247% down here in Pacifica. So that looks like the highest. So the slowest marketplace looks like it's Pacifica, Daly City, San Bruno up here in the north part of San Mateo County. I'm not seeing anybody higher, but you can see overall everybody's blue. This is where you're seeing that Silicon Valley is bluer than normal. So that means the market is slower than it typically is. But notice the Los Altos, Palo Alto, Mountain View area is pretty white in color. And then you come over here and look at it, Cupertino, Sunnyvale, 12% slower than normal. That's still in the range of normal. Normal starts at 114%, is that outside the normal. So they have 2% more before they start getting a little bit of blue. So they're still slower than normal. And again, Saratoga Los Gatos is a little faster than normal at 86%. Now here's Days Unsold Inventory. This is where I come back and start showing that even though the market's slower than it normally is, it's still fast paced. I mean, 24 days, 35 days, some of the slower ones is 125 days. That may sound like a lot, but keep in mind that's still only 4 months. And most areas in the country, as I said several times, consider 3 to 7 months to be normal. So 4 months is right in that normal range. But yet here in Silicon Valley, that's a blue marketplace. You can see that a lot of this is slightly shades of pink, which means you're moving fairly quickly. A shade of pink means you're between 42 and 78 days of inventory. Here's time for 3 out of 4 sellers to sell. Here, anything outside of 3 to 6 weeks has a color. So less than 3 weeks is red, more than 6 weeks is blue. And you can see the vast majority of the valley is red. You can see some areas are white. We have no blue whatsoever. So nobody's taking even more than 42 days. Can I verify that? Yeah, the highest number I'm seeing is up here is at 36. So 36 in South County area of Santa Clara County, which would be Morgan Hill, Gilroy, San Martin, is the slowest area for longest marketing time in 36 days. That 5 weeks. Here's your price adjustment magnitude. So this is the seller's ask price adjustments. The biggest one I'm seeing is Oakland at 1.8%. And anyone who's seeing it 1.7 in Atherton, 1.7 in Saratoga. And that's interesting. Saratoga Los Gatos is taking one of the highest price reductions, but it's one of the better turnover rates. And that may be like Alameda County. They're doing better because they're taking price adjustments and then bringing in the buyers. Where if you hold on to your price, you don't bring in the buyer. Here's your ask price frequency. So Saratoga Los Gatos at 22%. So it's got one of the most highest frequent price adjustments. Morgan Hill's got higher at 25%. That may be the highest. So Saratoga's got some company at 24 and 21 and another 24. So somewhere between 1 in 5 and 1 in 4 sellers doing a price adjustments is the most common area, which means 4 out of 5 or 3 out of 4 sellers are not doing any price adjustments. So again, you can see the heart of Silicon Valley is pretty red. You can see some of the outlying areas have some of the shade of blue. I think this is all remote work related. When we first had pandemic, these areas were bright red, and then people got called back into work a little bit more frequent, which makes these longer commutes a little less desirable. So bringing in the areas a little closer to home are coming back and becoming more favorable again. Here's the buyer's overbid. Again, you wouldn't have overbidding if buyers didn't feel the need to overbid. A buyer's not going to raise the seller's ask price as long as they don't feel they need to get the property. Here's the frequency of that buyer overbidding. Again, very common, red in color. Red in color is between 50 and 95%. You can see a lot of these are right around 70% of the sellers are getting more than their asking price. This is appreciation. You can see some of the outlying areas did better in appreciation. The areas that were close to the job centers did least well. And again, I think that's remote working. So I think one of the things that's, maybe not as prevalent now, but it's impacted the market in the recent past, so it's more impacting the market in the near future, is the frequency and convenience and amount of remote working that was allowed. Here's your pricing, and instead of following just the median number, which is the middle number, I give you a range. So the cheapest 10 percentile that you'd expect in an area, and the most expensive 90 percentile in a given area. So you know that 80% of the homes are between the extremes, and the midpoint is the middle number. You have it for each one of the micro market areas, and this allows you to see what's happening to property values more overall. And you can see fairly quickly the red here is the expensive areas, the blue are the affordable areas. So Oakland, Newark, Hayward, and then Livermore, Morgan Hill, the East Central and South San Jose, and Daly City, San Bruno area, Pacifica. And here's the chart that we started off with. So you can see that Saratoga Los Gatos is white, and red, where almost everybody else is blue in color. And again, it's because their inventory is lower. But if you come over here now, we can see their price adjustments at 22% is a little bit blue, and their magnitude of price adjustments at 1.7 is blue. So even though they're hot as far as compared to where they normally are, they're taking more frequent price adjustments. So it's probably the more frequent and larger price adjustments that are maintaining their hot marketplace. Here's my level of offers accepted, and you can see this year we're only accepting 81% of the past 10 years, and we have 2 years that are slower, and they were 2020 and 2023. And here we only have 2 years that were slower in the last 25 years. So that's where it becomes a little bit more significant. Out of 25 years, only 2 years were slower, and one was 2020, which was the pandemic year, and we were still being impacted by shelter-in-place data at this time of the year in 2020, and then in 2023, which was right after the 2022 price adjustment. So clearly, we're not healthy as far as the volume of transactions. Here's the raw numbers for each one of the counties: Santa Clara, San Mateo, and Alameda, and Silicon Valley overall. Noteworthy that San Mateo County grabbed that 2% increase in new listings, which gave them a 10% increase in active listings, where Santa Clara was only up 2.8% and Alameda County was only up 1%. So right there is another example of each county is doing their own thing. And combined with the large increase in inventory, San Mateo County actually saw a decrease in the number of offers accepted. Again, there's that week lag time. The 2% increase in new listings this week can't get impacted until next week's offers accepted. But it is interesting to see that San Mateo County went down in offers while their active inventory plus their new listings both went up significantly, where our Santa Clara County and Alameda sort of did the reverse. They went up in the number of offers accepted, but they went down in the number of new listings, and their total number of listings stayed relatively unchanged. So their offers went up by more than their total inventory went up, which is an improving marketplace. So these two are having a decreasing DUI, where San Mateo County had a huge increase. And 5 is sort of my threshold. So, in San Mateo County, I started paying attention to this. I think it's a 1 week fluke, and I think a lot of that inventory will be driven up next week, but you never know. Anyway, you can look at the actual metric for each one, and I have appreciation since 2015 as well as since 2020 if you want to see. And look at the difference. Santa Clara County has gone up 56% since the pandemic, where San Mateo County has only gone up 38%, and Alameda County has only gone up 32%. 50% to 100% bigger appreciation just since the pandemic in Santa Clara County. This is how you can participate live in the presentation Saturday morning at 9 a.m. We've been talking about the Silicon Valley real estate market. We will be talking about the Greater Bay Area, 13 counties and 5 regions. I'm Richard Calhoun, real estate broker with Creekside Realty, working on single agency transactions representing buyers or sellers. Appreciate a subscription and a like. My contact information is here as well as on the bottom of every slide. Appreciate any reach outs. Here are the 5 regions in the Greater Bay Area: Silicon Valley, we talked about, the city, San Francisco and Marin, North Bay, 4 counties, Central Valley, San Joaquin and Sacramento, and the Central Coast, the Santa Cruz and Monterey. Here you can see inventory is going up in all 5 regions fairly significantly. Here's the number of offers accepted. Offers came down in Central Coast and came down in Silicon Valley. It really didn't come down in North Bay. There's no decrease really here. There's no decrease in the Central Valley. There's no decrease in the cities. So 2 out of the 5 regions did a huge dip. Now, Silicon Valley is more high-tech oriented, maybe more investment in the stock market. You can speculate why the one region got impacted more than the other 4. And Santa Cruz, a lot of people might commute over, so it got impacted a little bit. But, the San Francisco, you'd think that would be impacted by the stock market. But for whatever reason, Silicon Valley was clearly the hardest hit region. And frankly, the only region that I would have ever picked up this U-shaped level of offers. You could say there's a U-shape here, but if I didn't have this dip, I would call this flat. So, Silicon Valley is the only area that was really impacted. So it's hard to say that it was tariff driven. It may have been stock market driven. That might be a safer thing to say, more documented by data. Here's your days on unsold inventory. Reasonable numbers. The highest is Central Coast. And if you look back over time, it's typically the highest. Silicon Valley is typically at the bottom of the graph, and that's what you have now. And the other 3 are in between. So you go from a fast marketing time in Silicon Valley of something like, what is that, right at 50 days? And then you go up to the cities at 60 days, then Central Valley at 75 days, then North Bay at 80 days, and finally the Central Coast, something like 93 days. Here's marketing time. Orders a little bit different. North Bay's got the longer marketing time. Central Coast did a big increase, but it's still below the North Bay. Central Valley, San Mateo County slowed down very recently, and Silicon Valley's been slowing down for a long period of time and was the first region to shift. It shifted way back here halfway through the quarter. Cities didn't shift until second quarter. Central Coast didn't shift to second quarter. Central Valley shifted towards the end of first quarter, as did the North Bay. So Silicon Valley, again, shifted earlier than everybody else. Here's the seller price reductions. This is the average, so very small numbers. Silicon Valley rolled over, but they all rolled over about the same amount of time. Central Coast has taken the largest price reductions, and it typically does. Silicon Valley is sort of up at the top of the graph most of the time and taking the least. That's exactly where we are now, although the cities is right above us, a little bit less price reduction at the moment, which is actually fairly rare. There's a little bit of time back here where the orange is on top of the purple, but it's happening right at the moment, and they're very close together. And then the other 2 are sort of in the middle. So normal pattern of price reductions. This is the frequency of price reductions. Silicon Valley and the cities are historically neck to neck with each other, and they're right neck to neck. If you look back historically, I would say blue and yellow are typically on top, and now yellow's on top, followed by blue and gray together. each region sort of doing what they do relative to the other regions, but each region's doing their own thing. Here's the magnitude of buyer overbidding. Cities has come out and bouncing flat. It's a small micro market area. So this could be basically flat with just statistical fluctuation. Silicon Valley is significantly bigger, so you have a nice smooth curve. But Silicon Valley's rolled over and coming down. You know, you could argue that North Bay is coming down a little bit, but I'd also call that flat. So Silicon Valley is more responsive than the other 5 regions for whatever reason. And on the frequency, same concept. Silicon Valley's clearly rolled over the most, but it still has, 69% of the sellers are getting more than the asking price. Here's the long-term appreciation, and Silicon Valley is also doing the best. The cities is doing the least well. You can see that the cities fell out since the pandemic in 2020. Until prior to that, it was sort of right in the middle of the pack, and then since the pandemic, it's gone below. You might argue that even the purple is sort of in the middle of the pack, and there really wasn't any difference until the pandemic, and then it percolated at the top, and the other 3 are still in the middle of the pack. Here's the median sold price. The cities are slightly higher than Silicon Valley, but they're basically neck and neck, right close together. And you can see that Silicon Valley is basically at or above their record previous price, and the cities is below their 2022 price, as well as their price earlier this year. So it's gone up and come down a little bit. But basically both regions are right at their previous peak, and that's across all the regions really. They're basically right at their previous peaks. Here's the monthly payments, again, using the 30-year Freddie Mac national average loan that you can beat or put more than 20% down, or have relationship banking or do an adjustable loan. There's ways to keep the payment down, but you can see that payments are going to be in the same order as the sale price. Here's the numbers, and here I have the current data, plus I have whether it's greater or less than a week ago. So inventory is up across the regions. I have each of the 13 counties, and then I have the 5 regions, and I also have the Bay Area, because the media talks about that. I also have 5 weeks ago, so you can see short-term trend from last week and long-term trend from basically a month ago. And you got a table of the whole data set. And with that, we're back to the chart that shows you the different chapters. There's timestamps in the description below. Appreciate any reach outs and subscriptions and likes. Again, I'm Richard Calhoun with Creekside Realty. Have a nice week. Take care. Bye for now.